Mr. van Overfelt, we have seen a strong rebound in emerging market indices since the pandemic. Now, the fundamentals don't speak for that. Are you surprised by this rebound?
Thank you, Peter, for this question. Yeah, I mean, it is true, of course, we have seen a very significant crisis in March. First, of course, a liquidity crisis. People were very afraid, had difficulty to price the risk, and we saw really a liquidity crunch into emerging markets, but also in developed markets. So people were rushing for the exit, and this has spurred policymakers, so Federal Reserve, but also IMF or European governments to step up the policy response. And in that sense, of course, this has helped markets to rebound. Now, if I'm surprised about the rebound, I think it's important to differentiate between the type of risk or the type of drivers of these returns. And I think on the one hand side, you have the decrease in risk-free rates, which of course leads to higher prices. And on the other hand side, you have the spreads, which is the remuneration you get for the credit risk you are taking. And so especially in emerging markets, spreads have not yet returned to the pre-crisis levels. So in that sense, yields are a little bit lower, especially for the investment grade side. But I think risks are probably fairly priced if you look at spreads today.
What are other risks for investors at the moment?
Well, I think there are really, if you invest in fixed income markets or in funds, let's say there are really, in my view, three different risks that one should take into account. So the first one we have seen and is difficult to mitigate is, of course, a liquidity risk where you see an indiscriminate sell-off. People rush for the exit and fundamentals really don't matter anymore because people want to get their money back. And then secondly, you have, of course, credit risk, default risk. So credit risk entails both a mark-to-market because spreads widen, or defaults because companies cannot pay back their debt. And a lot of investors really focus on this credit risk, but credit risk, I think you can actually diversify away. And then there is the final risk, is of course duration risk, is an increase in risk-free rates, is actually quite significant today. I think many indices have increased the duration because the rates are so low, so issuers take advantage of that. And I do think that some investors do not fully realize how much duration risk they are actually taking today. So I think that is something they should be aware of and should take into account.
Corporate bonds in emerging markets, they have taken a strong toll during the pandemic. Is that a sign that we are going to see more defaults in 2021?
Well, I think so. People are a lot focused on these defaults, and we see indeed a lot of headlines about defaults and restructurings in emerging markets. One thing I would like to highlight here is that this is so far have been mainly in the sovereign side rather than in the corporate side. And that is actually surprising to many people. And many people would actually think, well, if the sovereigns are defaulting, then surely the corporates are defaulting even more. And that is actually not the case because the indices have a different composition. So for example, the sovereign index has many more frontier markets that actually do not have corporates. And we have seen defaults in Ecuador, Argentina, Zambia, Sri Lanka is in trouble, but all these countries have very little corporates. And that means that actually there's not so many companies that are actually defaulting. And of course it has increased, but US high yield, for example, sees many more defaults. And that also has to do with the fact that many EM corporates are actually quite significant for the economies in which they are based. So they have also not only a corporate role, but also a policy role. And therefore, they often get government support and in fact have less likelihood to default. So defaults are going up or projected to go up, but much less than, for example, in US high yield. And I believe the projected default rates for next year are around 4 to 5% versus around 8% for US high yield, for example.
Now, the USA, they have elected a new president, Joe Biden. Joe Biden is expected to roll back some of the policies of the Trump administration. What effects do you see on emerging markets?
Yeah, so I think people talk a lot about US elections and the impact on emerging markets. I think for hard currency, at least, the impact is fairly limited. I think the main risk, as I said before, would be interest rates or stronger dollar, of course, would be major risks for emerging markets. And of course, it depends on the policies that Mr. Biden would take if such risks would materialize. Then Biden versus Trump, I think what is important is that markets don't like uncertainty. And Mr. Trump, of course, has injected quite a bit of uncertainty in markets. So I do think that if Mr. Biden can reduce the uncertainty, that would be a good thing. And then the second maybe positive thing we have to see is, of course, trade wars were very much the focus of Mr. Trump. And so I do think if we have policies that are more suitable to global trade, that should be positive for emerging markets as well.
So what opportunities do you see in emerging markets for the coming year?
Well, so I think there are actually emerging markets and especially emerging market corporates, I think, is very attractive at the moment. First of all, spreads have not returned to their pre-crisis levels in contrast to, for example, developed markets. So I think spreads are still quite high. And also the universe is very diversified. I realize that this is still an exotic asset class for many people, but you have a multitude of countries, so around 50 to 60 countries in the benchmark, within these countries different industries, different companies, and so that offers a lot of opportunities with still a very high spread. So I think we don't focus on individual sectors, but try to find companies that are attractive in their own right. If I have to single out one country, I think it's China. I said that before, and I think China bond market is so large. There are, of course, less attractive opportunities, but also very attractive opportunities in China at this moment.
Mr. van Overfelt, thank you very much.
It was my pleasure. Thank you, Peter.